Hey, welcome to this video. Barry Burns here with Top Dog Trading, and today we're going to talk about volatility trading strategies. So let's begin with the problem and then give you the solution. So one of the problems with volatility trading is that a lot of people will use this for scanning for markets, whether it's the stock market, futures, forex, whatever. And they are generally looking to scan for high volatility trading opportunities. So their logic in that is, well, I want to trade a market that's really moving, right? And it makes sense. There's a logic to that, certainly. Yeah, we want a good reward to risk ratio. We don't want to trade markets that are just consolidating and moving sideways. And so therefore, sure, it's fun to make trades in a market that's really moving, and your P&L goes up faster. It's more profitable. You make more money faster. Then you can take that same money, put it into another trade, and you can compound your money faster. So that all makes sense except for one little problem, which actually turns out to be a big, huge problem. And that is this. Volatility has cycles. That's the bottom line. The cycles move in many different ways. There are cycles that are trending and then non-trending cycles. Another type of cycle is the expansion and contraction cycle. That's what we're talking about today. High volatility, low volatility. Another one is randomness and chaos. That's a big one. We'll talk about that someday. Another one is just your swing highs and swing lows. That's the most commonly known type of cycles. But today, the type of cycle that I'm talking about is that the market moves between high volatility moves and low volatility moves. One of the easiest way to see that is with Bollinger Bands, and so that's what I have on here today. So Bollinger Bands are very just easy to see markers of volatility. And so here you can see the cycles. We're in a low volatility move here, and then the Bollinger Bands move away from each other. This is what you really want to see when you see the beginning of a new high volatility move, where the upper we're moving up. So yes, the upper Bollinger Band moves up, but you also want to see the lower Bollinger Band move down. And that is the key, where they're moving away from each other. So it's actually that lower, even though we're going up, the lower Bollinger Band is very important to look at that and make sure that it's going down. So that indicates that, okay, we're going into a high volatility cycle. And cycles are just time. So that lasts about, that long, I guess you could say. And then we go into a low volatility cycle again, and where the market has a very low range. So think of volatility as the range of the market. Alrighty, so low volatility, high volatility cycle. Low volatility, then guess what? We get back into a high volatility cycle. Then after that, guess what? From here to here, we're back into a low volatility cycle. Then from here to here, high volatility cycle. Then from here to here, we're back into a low volatility cycle. And you get the point. And the average trend on markets these days is 5 Barry waves. That's my own unique way of counting waves. And this one goes 7, so it gets extended, and that'd be a good place to start looking for a reversal, actually. So you can see the cycles of the markets moving from high volatility to low volatility. So here's the mistake that a lot of traders make, is they will actually use a scanner thinking, I want to get into a market that's really moving, and so they scan for high volatility markets. The problem with that is, by the time the mathematical formula of the scanner gets enough data to accumulate for a high volatility move, guess what? It's too late. It's too late. It's going to catch it probably around here. Maybe I'll use a different color here to make this more clear. Let's see, what color should we use? Let's use magenta. Okay, so it's going to catch it about here because it takes some data to to go through the mathematical equation of the scanner before it can confirm that, yeah, we're in a high volatility move now. Well, that's the problem. By the time it shows up on the scanner, it's late, and you are going to be late to the party, and you are about to enter into a low volatility cycle. And then you wonder, hey, how come every time I get in to a high volatility market, then the market goes into consolidation? So you try it again. And by the time the scanner and its mathematical formula crunches it and confirms it, it's up here. And you get in, you say, good, I'm in a high volatility market. And then the market just churns sideways. And then you start thinking, oh, my broker's trading against me. The market makers hate me. They're watching my individual account. The specialists are, watching just me and trading against me. And it's like, no, it's just that evidently nobody has explained to you the cycle of high volatility and low volatility markets. So as usual, what you want to do is the opposite. So you want to trade the low volatility cycle. You want to scan for the low volatility cycles. Why? Because now you got just the opposite. Just about the time that the mathematical formula of the scanner says, okay, yes, we're in a low volatility market. Guess what? It takes time for it to do that. And it might come up somewhere in about, let's say it comes up about here. And now you say, okay, cool. Well, great. So now's when I want to get in. And you can do this several ways. You can do the breakout of this high, or you can, by the way, one of the biggest questions is the direction of when you get into a low volatility cycle, basically a sideways move, whether it's a triangle or just a channel, whatever. Big question always is, okay, which way is this going to break out? And there's two answers to that. Number one, you want to trade it in the direction of the trend of the chart interval that you're trading, but only early in a new trend. Reason for that is the trend is your friend until the what? And you know the answer to that. The trend is your friend until the end. And what does that really mean? That's instructional. That's not just a cutesy quote to remember. No, that is teaching you something. If the trend is your friend until the end, then at the end, it's what? Your enemy. So the meaning of that slogan, which is very critical to understand, is that you should only trade in the direction of the trend early in a new trend. So that is what that saying is really meaning. So if we can catch this, then that's golden. That's your first retrace in a new trend. And if you can take it here in this breakout, that's very good too. Maybe even a little bit better. So then again, you scan for the low volatility market and catch it coming out. Scan for the low volatility market. Remember, this had actually been a low volatility this whole time. So it's got enough time to calculate in the mathematical equation. Same thing here. And you want to get in early on this. So I would actually want to buy this low, this low. I don't personally wait for the breakouts. A lot of people wait for the breakouts. And that's cool. That's an old-fashioned traditional way of doing it. But you're giving up a lot of your reward. First of all, your risk is greater because in these examples, getting kind of messy here with all my drawing. But basically, if you wait for it to break out of here, you've already given up all this. And I would have gotten in above the high of this bar here. So my risk is much smaller as opposed to the risk of about that. And then not only does it make your risk bigger, but then, of course, it diminishes your reward as well, as opposed to that reward. And that's just your half cycle, obviously. So risk-reward ratio on breakout trades, not nearly as good. Prefer to get in inside of the contraction. And that's the key, buying it inside of the contraction. So that is one part of it. The other part, as far as direction to trade, is only trade in the direction of the dominant energy of the longer-term time frame. So that is the second answer as to how to determine which direction to take these consolidation trades. And you put all that together early in a new trend on the setup chart in the dominant direction of the longer term chart, and trade inside the consolidation so your reward risk ratio is better. Also, you're getting in before the retailers, so you're getting in at the same time as the professionals. Retailers always wait for too much confirmation. If you wait for too much confirmation, you're late to the party. And that's the problem, because they don't have the confidence, the skill, or the knowledge on how to get inside the consolidation. So if you'd like more information on how to trade inside a consolidation, I have another YouTube video on that, on triangles. You can either just search in YouTube for it or send me an email and I'll be happy to direct you to that. So, hey, if you like this video, please understand that sure, it's free, but if you got value from it, you actually have a moral obligation to pay it forward by clicking on that lovely little share button below. Believe me, the spiritual satisfaction you'll get from that will be very, very rewarding, and karma will be kind to you. In addition, if you're watching this on YouTube, please click the thumbs up icon below. And hey, I'd love it when you leave comments. That really encourages me to continue to create these free tutorials for you. And finally, I'm giving away one of my favorite trade strategies. It's called the rubber band trade, and it has a very high win-loss ratio. I'm going to give it to you absolutely free. It comes in the form of a 26-minute video. And you can get that rubber band trade strategy by simply clicking on the image in the top right corner of this video, or in the description below the video. There's a link there for it too. And if you happen to be watching this video somewhere other than on YouTube, there's probably a link below or an opt-in form on the side. Anyway, once you do that, I'll personally email the video to you with the rubber band trade strategy.